Prediction markets are signaling something about the Federal Reserve that is just impossible to ignore right now. Seriously, it is one of the clearest economic forecasts we have seen all year.
64%. That's the probability the market is giving to exactly 3 Fed rate cuts happening in 2025. This isn't just some vague guess. It's a high-conviction bet on a very specific, very dovish policy.
And look, this is not just wishful thinking. We're talking about a bet backed by over $12.8 million in real hard volume. That makes it one of the most significant economic bets in the entire market. But here's the puzzle. If the Fed's path is so crystal clear, why are other key sectors showing so much skepticism? Why are they betting against a rally? That's the contradiction we're going to unpack. Drop a like and share if you find this valuable.
Okay, so let's get right into it. The main idea, the core thesis that is just completely dominating the market right now is this unified, super powerful expectation of economic easing, and it's all being driven by the Fed.
I mean, just look at this. You can see the remarkable lack of ambiguity. You might hear all sorts of debate on TV, but the money, which is the only signal that really matters, is flowing to one single outcome: 3 rate cuts. The conviction here is just undeniable. And the logic is pretty straightforward, right? A dovish Fed means cheaper money. Cheaper money should, in theory, create a massive tailwind for risk assets. We're talking stocks, crypto, the whole shebang. So that's the baseline theory we're going to put to the test. Make sure you subscribe to the YouTube channel so you never miss one of these deep dives.
Okay, now let's dive into the first major contradiction. What we're seeing is this stark, glaring contrast between that economic certainty we just talked about and what you can only describe as profound political uncertainty.
This side-by-side illustrates the disconnect perfectly. On the left, you've got that single, high-conviction 64% bet on rate cuts. So clear. Then you look to the right, and the market for the 2028 Republican nomination is just completely fractured. There is no clear frontrunner, nobody with anywhere near that level of conviction.
You know, even the leading candidate, J.D. Vance, is only trading at 50 cents on the dollar. That's basically a coin toss. This massive political uncertainty creates a huge risk that stands in direct opposition to the market's calm confidence about the economy.
Now let's see how this all plays out in another key sector, crypto. You would think, with rate cuts pending, this would be the perfect environment for growth. But the crypto markets are signaling a shocking lack of confidence. For more real-time updates on these markets, go ahead and follow us on Twitter.
Take a look at the actual data for Bitcoin. Traders are overwhelmingly betting, we're talking a 76% probability, that Bitcoin's price is going to stay below $80,000 this year. And there's only a tiny 5% chance assigned to it breaking $150,000. This is absolutely not what you'd see in a market expecting a huge risk-on rally. And it's not just a Bitcoin thing. Look at Ethereum. The market sees a 71% chance it stays below $2250. This shows a broad lack of conviction across the biggest assets in crypto. And it totally contradicts that tidy little theory of economic easing, doesn't it? So if the main consensus bets are just full of these contradictions, where is the smart money actually going? Well, let's look at the outliers, the low probability, high impact events where traders are placing their real hedges. If this breakdown is helping you connect the dots, please share it with someone who needs to see it.
Okay, this is where it gets really interesting. What you're looking at here is a $1.7 million market betting on an event with only a 4% probability. So why would a long-shot bet like this attract so much capital? Well, because when the potential impact is world-changing, even a tiny probability is worth hedging against.
This is really where you can see the market's underlying psychology, its deepest fears, its potential blind spots. They're not in the 64% certainties. They are hiding in the 4% outlier bets that most people are completely ignoring. So what's the big picture here? What does this all mean? Let's synthesize all these pieces, the certainties, the contradictions, and these weird outliers to form a coherent, actionable strategy.
So here it is, all laid out. The market is extremely confident in 2 things: a dovish Fed and the dominance of specific tech players like Gemini in the AI race. But at the exact same time, it is actively hedging against political chaos and has very, very little faith in a broad rally for major asset classes like crypto. Be sure to subscribe so you don't miss our next analysis.
So what should you take away from all this? First, the market believes the Fed's path is pretty much set in stone. Second, the real anxiety isn't about the economy, it's about politics. Third,
Don't expect a big everything rally. The conviction is highly concentrated in very specific tech narratives. And finally, and maybe most importantly, if you want to see the next shock coming, you have to watch those low probability, high volume outlier markets.
And that leaves us with one final critical question. In a market that is so certain about economic policy but so anxious about literally everything else, where is the real risk actually hiding? Is it in the things we think are certain, or in the anxieties that are already being priced in? Let us know what you think. And hey, subscribe and drop a like below. Follow us on X for more updates, and we'll see you in the next one.